If you have a loan and you currently have enough money to pay off that loan, should you pay it off early or should you continue making those monthly payments until the term is over? Find out in this episode. Sturgis Credit Repair is a 5-star rated online credit repair company. We help people just like you build or rebuild their credit scores. If you have no credit history, we offer products to help you build credit history so that you never have to depend on anyone co-signing for you. If you have bad credit, enroll into our service today and allow us to work on the negative items affecting your credit scores. We take no money up front, so start our service today for free. You'll get updated through your online account as well as receiving updates through your email. For those who are trying to buy a home, we're partnered with multiple real estate agents and loan officers who are ready to assist you with your goals. If you are a real estate agent, loan officer, or anyone dependent on customers with good credit, create a free partner account with us today. You can manually send or receive clients through your online account as well as track their progress before they go to someone else. Visit our website to learn more about our services. All right, so in this episode, I'm going to kind of break down the difference between paying a loan off early or just leaving the loan open for 5 or 6 years that you're financing the account for. So I get asked this a lot. Some people may have an auto loan and they're in their second or third loan to where they paid off most of the vehicle, and this vehicle is just costing them monthly payments every single month. And of course, included in those monthly payments is interest. So a lot of people reach out and they're like, hey Chris, I'm paying this car note every single month. I have 10 grand in my bank account or 15 grand in my bank account to pay the rest of the car off. Should I pay it off or should I just keep making payments and keep building my credit score? So before we show you the difference here, or before we talk about the difference here, the biggest false information out there is if you pay an account off, your credit score drops if you pay it off early. That is not true. The account still reports for 7 years. Now, what people may get confused with that, yes, whenever you pay something off and it reports for 7 years, and after 7 years the account falls off your credit report, yes, all of that credit history that you have built with that account is deleted. It falls off every 7 years. Just like if you have a late payment on your credit report or a collection account on your credit report, after 7 years, that account falls off your credit. Secondly, the longer you build your credit history, the better your credit be or will be. So a lot of people reach out and say, hey, I have a 750 credit score. How can I get to an 800? Well, all of your open accounts, keep making payments every single month until your score reaches into the 800s. You're never going to get above 750 or above 780 or above 800 unless you build credit history. So you can't just open up an auto loan, pay it off the very first payment and just keep doing it over and over and over. Eventually, maybe you can if you're 200 years old, but you will never get to an 800 credit score unless you continue building credit history. So let's look at this for example. Right here I have a loan and these circles represent years. So let's just say a 6-year loan and then you have 6 years worth of interest. So let's say a cheap vehicle or a moderate price vehicle is costing you $2,000 a year in interest. So you have to determine which makes more sense to you. If you have good credit or perfect credit already, then building credit isn't really a big concern on you, and you're more worried on how much is this costing every single year. Vice versa, if you have bad credit or not the best credit, you're probably willing to pay $2,000 a year in interest as long as it keep building your credit score. So let's just say someone's trying to build their credit. They finance a vehicle 1 year, 2 year, 3 year, and they get to year number 4, and they're also paying 4 years worth of car payments, which result in 4 years worth of interest. So you got 2, 4, 6, 8. That is $8,000 in interest that this person have paid over the length of this loan. So let's just say $8,000 in interest, which is a lot. So This person have paid $8,000 in interest. They have closed the account after 4 years. So now they have 4 years worth of credit history. So this is kind of an example how this works. So after 4 years, they paid $8,000 to the bank for borrowing the money against it. So again, this goes all the way back to building credit scores versus paying interest. You, as a person, you have to determine, is $8,000 worth building 4 years of credit history, or is $8,000 within within 4 years worth building your credit history so you won't have bad credit anymore. So to get into the 800s, you want to at least have 6+ years of credit history. A lot of people think they can just go out and open up an auto loan or a credit card, keep it for 2 years, close out the account. I mean, yes, you may have decent credit, but you're never going to get into the 800s unless you have, 5, 6, 7, 8 years worth of credit history. So let's just say you took this 4 years of credit history that you've been making on-time payments with, and you close the account after the 4th year. Well, you never finance nothing else. Well, yes, you may have a 700 credit score, 715, 710 credit score for all of those 7 years that this account still reports for 7 years. But once this 7 years is over and that account falls off, you're going to be right back at a 0 credit score. So that's why it's very important to keep building credit and keep, I wouldn't say keep making on-time payments, because if you have multiple accounts and multiple accounts to where, let's just say you have credit card accounts to where they're open, they're paid on time every single month, you're paying the balances by the due date, it's not costing you anything to leave those accounts open. Unless you're maxing out those credit cards and paying the minimum payment, then yes, you're going to get charged interest. But let's just say you have 10 credit cards that you have had 10 cards that you have had for 8 years now. Well, once you close out this auto loan with 4-year history, you can cancel out credit history. Well, you still got those 10 credit cards with 8 years of credit history, and you're still going to have a 800 credit score, even if this account falls off after 7 years or so. So most importantly, I guess the outtake of this video is just to not worry about focusing on paying off an account early and if it's going to decrease your credit score instantly, because it's not. Actually paying off debt early, it's actually a good thing to have your balances reported at 0 even for a loan. So yes, it is safe to pay off your loan early. No, it will not instantly drop your credit score because it still reports for 7 years. No, it's not going to benefit your credit score in the long run because, like I say, longer credit history means better credit. So paying off a loan early, it's not a bad thing, but also if you're trying to focus on building credit scores in the long run, it may not be the best option to pay off that loan early. So I hope you guys learned a lot from this episode. I know some things may sound a little confusing, but I guess long story short, if you're trying to build scores and your scores aren't the best, keep that account open and just keep making on-time payments. If you have some pretty decent credit scores and your credit score is already established, then yes, go ahead and pay off that loan and stop worrying about paying interest every single month, because that's just money coming out of your pocket and into the bank's pocket. So thank you for watching this episode or listening to it. If this video helped you, be sure to like it, comment, share it, and subscribe to this channel for more helpful videos like this one. Thanks for watching.